Welcome to the Habito Landlords Meetup in November. Thank you for taking the time on this momentous day where there was a budget announced by our Chancellor of the Exchequer. Everything I was looking out for did not happen. It was not denied either, but no announcement of an extension of stamp duty or anything on capital gains tax. But of course, a lot of economic context around the UK and the impact of Corona, which showed a V-shaped recovery, which is great. But also, my God, what a way down we're going through first. So we'll talk a bit about the impact on property market later today, where we are feeling, of course, negative compared to how we thought that the year would pan out, but more positive maybe than a few months ago even. But let's, I think it's a good time to try to make sense of this all. So thank you for joining. We have a fun-packed agenda for you. I will say a little bit about things we see on both our brokerage and lending side at Habito, what we're seeing in the market. But then in a more detailed look at what's going on in the market and trying the impossible task of making predictions for 2021. No doubt with a big legal disclaimer is Kate Faulkner. Thank you for joining, Kate. And Chris Norris is joining us to talk about green home grants and give an overview of what is quite a growing bit of the market and will be more so in the future years. We're all going to talk for a bit and use slides throughout. Do ask questions via the Q&A function. You can do it in the chat. We're doing a question and answer session at the end. So please do ask. We can see them. Oh, my daughter joins. Hello. Thank you very much. Excellent time.
We're really having one of those nights tonight, aren't we? Everybody's coming in.
So do ask questions so we can answer them. We'll watch them throughout. We'll try to do in a big block at the end. If there's something burning, we may pick it up throughout. We are recording this session and we will put it on both YouTube later and share it in our Buy-to-Let newsletter, which I would encourage you all to become a member of. So with all that, let's get started. So I introduced all of these esteemed speakers and myself. So Habito, I had the lending part of Habito, but I thought not to speak too much about us, but a bit about what we're seeing through our brokers. And the big thing is, well, how did COVID feature in this year, and what does that tell us about volumes for the next few months? So for brokerage overall, so owner-occupied and buy-to-let together, this graph shows how many submissions we've seen. We've indexed it because the absolute numbers don't matter that much. And so the green or teal bit in the middle is in April, the lockdown of COVID. And you can see that the volumes before were bigger. It was quite low, dropped by about 60%. And then since COVID, we've been lucky to see a return to roughly the same level, where August was spectacularly busy, and since then it's been going okay, sort of in line with seasonality. But I think we didn't just see pent-up demand, which we were worried about when the lockdown ended. We're seeing actual demand continuing. It is stronger on the purchase side, I'll say a bit more about that, than on refinancing. So people are buying houses, some are even seeing opportunities, and it is continuing. So overall transactions are okay. We are clearly, like everyone, making sense of the changing and detailed rules for tiers that will come in after the 2nd of December. So surveys have continued to be possible in this second lockdown. we think that viewing will be, as far as we understand, viewings will be easier as well. So we think the purchase pipeline will definitely not weaken, if anything, strengthen. What we're seeing on the mortgage side is, and I'll say more in detail in a bit, is the service levels. It is very hard to get a purchase through in time for stamp duty to come back in at the end of March. And that's particularly on the legal side. Conveyancing are saying, if we're realistic, the searches with councils are taking so long in this sort of COVID secure world that if you start now, it's going to be very tight to hard to get a purchase completed before that deadline. Which, as I said in my intro, we're not sure if it's not going to be extended, but it looks more likely that it's not an extension given the silence today. So if we take that same view and just look at buy-to-let, we see a similar picture with a couple of interesting variations. So roughly back to the same level. We've had a higher drop of higher LTV products, so it's very hard to get an 80% LTV mortgage, for instance, in the market, and a bit more splits. So there's been quite a few cash purchases, but in mortgages, it's okay, but a little bit less than before COVID. And there's some signs to assume that that's going to be increasing in the next few months, but it's conflicting signals. We're seeing an increase in people buying through a limited company, which is helpful given the tax change that Osborne announced a few years back, but particularly with the absence of stamp duty, transfer from individual to company is something that some of our customers are doing right now. So you can do the transfer without at least SDLT. What we're seeing in our products ourselves is we're selling loads more, and that is, so these are our own mortgages. And we are seeing that, first of all, we have a bigger range. So we do company and portfolio now, so that helps. But we're also seeing that there's a lot of people in a rush. So online friendly mortgages are having a moment, which we of course think is going to be a lifetime. So we're doing a very good business across, and again, a bit more on the company side and a bit more people with 3 to 6 properties is the sort of sweet spot we're seeing. And then last thing that we notice in the market is that we are, there's a couple of things pointing out, and then I'll talk about service next. One is more purchase than remortgage, which I said already. So you see where it was 28% of transactions before and the rest refinance. It is now at 44% and rising. So prevalence of purchase. We're seeing this, the middle graph is the percentage of transactions done in London of the people we see in brokerage. And where there was 18% before lockdown, it's been 15% since. So we're seeing a little bit less. And I think that's not a COVID thing. That is a worry about house prices. There's a little bit of stories around people moving to the countryside for a new life. I'm never sure if that's just journalists and bankers, and whether that's actually a big enough group to warrant. But we are seeing a weakening of investing in London. My personal view is that is a continuation of the longer 2-year trend of actual yields in London being depressed compared to some other buying opportunities in the rest of the country. I think the stats that Kate is about to show will give a bit more of a sense of whether that's rational. And then we're actually seeing overall a flat percentage of people using limited companies rather than having a buy-to-let mortgage in their individual name at around 11%. As I showed you on the previous slide, we're seeing in our lending business that we are seeing more of that and growing, but our products are particularly suitable for a limited company. So, and that's the last thing to point out. What are we seeing in Habito lending? Well, we're seeing that we get a lot of positive feedback about our service levels, which are same-day offers. where the case is complete. And that is much more important than it was half a year ago, as sort of the concept of are you fast or slow is no longer the difference between are you 7 days or 20 days, but there are faster players like us, which can say, well, we can give you a good idea in the same day and a full offer in 12 days. And the market walking out to about 24, 27 days to an offer in total. Finally, on pricing, there has been a lot of movement in the lockdown. There was a complete bunching up of everyone had only 60% LTV pricing, and the price was pretty similar as well. We've seen more of a change, some interesting things going on with low fees and are there purchasing included. We think at 75% pricing, the rates are quite stable. So we are pricing that at 344, where our price is starting for low LTV at 3.14. What is unique about our products is we've launched a cashback offer because we think there are a few people in a rush, and we're trying to signal as a new lender, please try us, we're fast. So we're making that a bit more interesting with a cashback of £500 upon completion. And we're continuing to see this prevalence of 5-year fixed and to a lesser extent 10-year, where even a year ago you'd see a lot of 2-year fixes. We're seeing more of that longer duration, and we're pricing for that. And then the criteria, I think there's quite a good spread in the market. We are particularly focused on things done less good. So limited company I talked about, making sure there's fee assist, so conveyancing and surveying doesn't have to be a big cost outlet at the front. And a bit more what we think is reasonable criteria, like if you're a bit older at the end of term, or if you're younger at the beginning of term, or if your tenants have benefits, we do allow that, just like ex-local authority properties. So all in all, making a bit of a name in some criteria. And we sell both via our own brokers and via other intermediaries of different networks. So we're pleased with growing us. We're in this for the long haul. So we think if the market is healthy, we'll do all right. So let's hear more about that market by me handing over to Kate.
Hi
Kate,
there.
over to you.
Thank you very much. So always good to know. I always thought that we never get huge amounts of information on the mortgage side. So I think it's really helpful to have that update. If we just go on to the next slide, I'm going to run through all the thoughts of 2021. They might be utter rubbish because, let's face it, the forecasts from earlier in the year were utter rubbish. So we'll have to see how we do. But hopefully, I mean, I quite like looking at the forecast because it's interesting to see what everybody else thinks. Of course, it's down to your individual property on the street these days, but it's nice to kind of, when you're looking at your portfolio for next year, or if you think you're entering the market or exiting the market, it's nice just to have a little bit of an idea to know what everybody else is going to think, to see, because it might impact on your decision as to what you want to do. So if we run through a couple of slides, we're going to go to look at property prices first, because that's always exciting because they tend to shift a lot. So if we can go down to the latest forecast slide just after this one. So the fascinating things, I actually nearly fell over when I saw some of the forecasts, because it was still at a time when everybody's fairly confident the market would fall next year. So I know a lot of chat on buy-to-let forums, etc. It's like, oh, I can't seem to get anything at the moment, and market's at the top, and everybody's going, don't worry, it'll all crash around next year. Well, not according to the forecasters, it won't. So Savills, to be fair to them, came out incredibly early with a forecast when we really didn't have an idea economically of what was going to happen. So their forecast was that prices would fall by about 7.5% this year. That wasn't unusual compared to other forecasts. Property side about 5 to 10%. Other forecasts were up to 15. And now, I mean, this is just a turnaround we have never seen from forecast to actuals in the housing market, where they're actually now predicting a 4% rise, and that's fairly in line with everybody else, as you'll see in a minute. And for 2021, it might not be an exciting forecast to say prices aren't going to change much next year, but considering everybody thought and we may well be heading into a massive recession still, to have no change in property prices would be quite a phenomenal result, quite frankly. And the good news is this year, unless you wanted to buy a bargain price, of course, is that prices, transactions, and in the main rents, not everywhere, particularly I know in London it's been tougher because of all the service accommodation stock that's come on the market. Pretty much everything's held up pretty well. So the big question for next year is, will it last? So the first thing we're going to look at on the next slide is from an economic forecast. So there's loads of them out there. We've obviously had more out today. I've used the sort of Oxford Economics through Savills. These seem to be about similar, I think, to what everybody else is looking at. You might be a little bit higher, a bit lower, but the point is that we are in for a major contraction. We know this year, particularly with the second wave and second lockdown, but we're looking to recover pretty well next year. And really economically, what everybody's saying is quarter 2, 3, maybe even quarter 4, 2022 is when we're going to kind of be back to where we would have been if COVID hadn't hit. Income's expected to be hit this year. Typically, income's tied in with rents. So not a surprise. I'm getting a real mixed picture, as you'll see later, on what's happening in the rental market. But income's seeing a good rise. And that is a good rise. I mean, basically, bearing in mind that most incomes have fallen in real terms over the last sort of 10 years or so. To look at 3.5%, 4% rises even after this year's fall is pretty successful. The unemployment one is quite critical, and there are quite diverse views on this. So if we hit 6.5% this year, we'll have got it lightly. Some of the original forecasts, I think midterm were about, the mid forecasts were about 10%, and some of the really, it's going to be bad out there, were 14%, which would have been double what we would have seen in the last recession, for those of you that lived through that. So, but we should be getting back to where we would normally be, as I say, at the end of quarter, at the end of 2022. Good news is base rates are expected to stay low. And although Martin is much more of an expert on this than me, the good news is from a buy-to-let perspective, always, if you can, not necessarily a good investment if you're going to use cash, but definitely it's being able to get a mortgage and having that leverage that typically gives you a better return than other financial investments. And nobody ever predicted back after the last recession that mortgage rates would remain this low, but it is one of the main reasons why property could still deliver if you get it right. So let's have a little look around what's going to happen around the rest of the country. If we go on to the next one, we can have a look at the forecasts over the next couple of years. So we try to update these as fast as we can. And when I say that, I literally sent these slides over about 2 hours ago, as we had some more forecasts coming out. So what we've got here is the Savills forecast for the UK and by region through that they came out in for this year, sorry, for 2020, and then what they're predicting for 2021. Same for Hampton, same for JLL. The PwC ones, now they are out of date because they wouldn't produce a regional one this year, but I've left them in because actually they're not bad at forecasting, and I don't think their forecasts will be far off. So the kind of key thing on this, I think, is that very much looking at a zero forecast, and who would ever get excited about a zero forecast? But you would be if you saw those 7.5% this year. So much better returns than expected this year, and that's pretty much being forecast across the board. So this sort of 3-4% price rises, and then either nothing or a little bit of falls, maybe somewhere along the way. Interesting, Hamptons haven't been a big forecaster in the past, so this is their first sort of foray into this that I've seen over the last few years, and we've been tracking forecasts for about 7 or 8 years now, if not longer. So they're looking at some falls maybe in London for next year. That could be about right, but whether it's 0% or 1%, who cares really? It gives you, you know, it's not the 15 to 20% that some people have been thinking. The PwC, out of all of the ones that we've looked at in the past, have been the most consistently correct over the last few years. And their forecast for house price growth, they haven't given us any regional ones, sadly, but they're reckoning they're sort of along the lines of Hamptons, really, about 1% for next year. So nothing startling there, to be honest, in terms of what we're expecting to see happen. What gets more interesting is we pop onto the next slide, we can have a look to see, these are the 5-year forecasts. So they are from different time points, because we don't always get the data. Night Frank comes up in December, and I'll happily update these slides if Habito okay to send the update out. And the interesting thing, the other reason why I've kept in 5-year forecasts, even if they're based on 2019, is because in the main, when we look across all the 5-year forecasts that we've seen over the last few years, what all the forecasters are saying, look, is we've got a bit of a knock next year and maybe the year after, but then they're really sticking pretty much to their 5-year forecasts. So the really interesting thing to take from this, so you've got Savills saying 20% up over 5 years, Knight Frank saying around 15%, and JLL the same. The biggest change, which is a dramatic change actually, is that for several years now, Savills have been saying that London property price growth would be at 4% over a 5-year period. That's not per year, that's over a 5-year period. They have absolutely jumped that up to 12.7%. Now, whether that's because of I've kind of looked to see why that is, whether that's because some of London has seen some falls, so they're looking at some sort of recovery over the next few years, but that is quite a substantial change. And also they've bumped up things like the Northwest, for example, which is a very busy market, and Wales as well has seen a slight change. So there are slight changes to these forecasts, but pretty much everybody's saying, look, whatever we predicted this time last year, over the next 5 years, we're going to stick to that. The important thing to know, though, is that when you look at inflation, it's probably down, the average inflation every year is around 3%. When you look over time, it's probably going down to 1.5–2% over the next few years. And not all of these regions, if they grow at these rates, particularly with Hampton's one, which is perhaps one of the lowest forecasts, because you can see everybody else is pretty much in line. If you buy with cash, and your property in London, for example, you buy with cash today and your property in London over the next 5 years has gone up with 6%, you will lose money on that property, because that property has to be going up by 2% every year for each year over the next 5 years, just to stand still, just for that cash to be the same. Then what you've got on top of that, you've got to put all your buying and selling costs. And that's why you really need to think, if you own property with cash, or if you are thinking of buying with cash, it's okay to do it initially to get a good deal. But really the reason buy-to-let delivers is because you are allowed to leverage, and that allows you to make more money out of that cash. So you've got to seriously have a good think about that over Christmas if you haven't thought before, because in the main, when you look since 2005, apart from a few areas like London, like the Southeast, most areas have not seen their average property prices keep up with inflation. And I think there's a lot of buy-to-let investors out there that haven't understood they're actually losing money on that asset, even if they're kind of enjoying the income. Slightly different if you're looking at HMOs, because that's very much income driven, so you might not care about the price of the property, but it is important to bear in mind. So if we go a couple of slides on, we should head towards transactions, which really should feature a lot more than they already do. Hampton's produced a useful chart, and actually I didn't have time to put it in today because it would have messed things around a little bit, but Home Track have just done a really, really good survey, and they go back I get very excited. They go back transactions to 1981. But anyway, what this tells us is normally, and it's always good to have a norm in your head, the number of transactions that we would normally, properties we would buy and sell, is 1.2 million a year. And that kind of is a really, really good historic average. So you can see there that, boy, were we overdoing it when we headed into the last recession. Things had gone a bit nuts. Prices were going a little bit nuts. So it's not a massive surprise that we saw a big drop, and we didn't start to see that turning around till 2013. Since then, we've pretty much done that average. The forecasts, so you'll see, we're really expected to drop substantially this year. So if we can hit 1 million this year, and we can see that grow as Hampton's forecast. And one thing I would say is where there's differences on price forecasts, everybody that's forecasting on the transaction front is pretty much saying the same thing. So if we pop on to the next one, I've compared the Savills forecasts and also from what they were previously doing, just to really reinforce what a remarkable recovery really, or what a remarkable year we've had this year. So everybody's looking at 1 million to 1.1 million for next year. And but the prediction was that we'd be kind of way down on that this year from Savills, and then pretty much going back to our norm by, again, 2022. So that's matching when we're expecting the economy to go. I think there might be something else under there if you just press a button, Marta. there we go. So what we've broken down here is the Savills have broken down, which I always think is quite interesting, the actual individual reasons for getting a mortgage and for purchasing a property. So what they're saying is that they're expecting mortgage first-time buyers, for obvious reasons, they can't get the LTVs that they would normally have. They've fallen by around, they expect them to fall by around 20% this year. And again, we've got to remember is that means there's a lot of pent-up demand still out there, and they can't get back into the market. They won't, and it's a shame really, because obviously the stamp duty doesn't matter to most of them, because they can buy for 300,000 without it. But there is still some pent up demand for next year when the when 95% mortgages hopefully come back. Mortgage home movers, not that different. That's because that's one of the real drivers of the market. They're expecting buy to let, and that's where obviously Habito look like they're outperforming from my perspective, which is good news. They're expecting to see a fall, and that's a lot of that's because people are going, well, I don't want to, you know, sensible investors going, well, I don't want to buy now if while prices are so high. And cash buyers clearly not affected that much by the market at all. And then they're expecting to see the growth in each of those markets next year. The mortgage home movers one, most of that will probably come in Q1, because that is demand that's coming through already now in the pipeline. And we know that the market's really been driven by second steppers this year. So, and it kind of talks through, and I'll leave you to have a look at this, obviously, because you're welcome to have a copy. But it kind of explains all the differences between the different purchases, if you like, of properties. This issue is, and it'll be interesting to see what Chris's sort of thoughts on it are as well later on. This issue of possession, I'm not sure we've quite got our heads round the potential damage that could be done to the market and to landlords by just forcing a 6-month eviction notice. And certainly in England, interestingly, not in Scotland and Wales, who you could say have been a bit harder on landlords as far as making them sort of stick to rules, are concerned. Both of them introduced loans for tenants, not being done here. Very clear in my mind, the government is expecting landlords to fund tenants through COVID difficulties. So somewhat harsh. We have tried very hard to get loans, but they're clearly not interested. I think that will come back to bite them very badly come January, February next year. So that kind of walks you through the transaction side. So for those of you who love your rental income, let's go and have a little look to see what's happening there. Office of National Statistics, they produce a fantastic index every single month. It's probably one of the most robust across the country. Unfortunately, it only goes down to sort of regional levels, but it's just a bit of a shame that all the MPs and mayors that accuse these evil landlords of skyrocketing and extortionate rents don't read this, because it is very good data, because as you can see, the annual private rent index, and this has been like this for some time now, is just this massive extortionate skyrocketing of 1.5%, which is pretty much how it's been for some time, as I say. So that kind of tells you what has happened. Interestingly, if you're thinking of looking at different areas and you're not sure where to invest, certainly the Midlands, if you go on to the next slide, is looking pretty good. It's looking pretty good. I'm from Nottingham, and we are consistently topping the charts this year on house price growth. What I would warn you as is I know Nottingham very well, and I can tell you that there are some properties that are still probably 20-30% down in value versus what they were sold for in 2007, 13 years ago. So as ever, certainly if you're a London investor and you're looking to move out to other parts of the country, be very, very careful, because there are some areas that do very well price-wise. There's a lot of areas where actually, do you know what, we haven't got the economic growth that you have, or the strength of London, and as a result of that, you can get your fingers burnt, particularly if somebody, I love seeing these offers of, oh, you can buy this house for 70 grand, that often sold to Londoners, only to find if you'd actually got on the train, which we're not really allowed to do at the moment, and popped up to the north, then it's probably selling for about 45 grand on the ground. So beware of that. But Yorkshire, Humber, East Midlands, West Midlands and the Southwest doing pretty good, with slightly above average inflation rises. And part of that is, so I know the East Midlands very well, is we haven't seen huge rental rises in these regions that are doing well now. So there's a definitely sort of ebb and flow in terms of how rents are doing. And if you go on to the next one, just to kind of explain explain what's happening a little bit there. This is the Savills and this is the Hamptons forecast. Savills are very, very straightforward, if you like, on their rental forecast. They look at rents typically tied in with income. So if income falls, rent falls. If income grows, rents grow. And what they do is they sort of pretty clearly look at, right, if income's going to go up by, if we look at 2021, if you look at the bottom, it says income growth 5.4%. I know it'll be 5.5% in the UK and a little bit more in London. And that's pretty much how it works. So I think that, though, is quite a high figure. I've got an index which I'll show you some data from in a minute, that I run for Belvoir, one of the big agents in the country, and we've been running it since 2007. We've learned a lot about rents, and the one thing you learn is they do not jump around massively. In fact, I've been told my reports are extraordinarily boring sometimes on rents because they don't really move up or down that much. So I'm not 100% convinced about the 2021 figures, maybe more correct 2022 onwards. But I have to say, if I'm going to make a bet on who's right on these, I would personally, if I was forecasting from a financial perspective, I'd definitely run with the Hamptons one. And if you get the Savills one, then you can be very happy Kate was wrong and Savills were right, and that's the direction that you would want to head into. And if we go on to the next slide, and I put these on, I'm not going to run through these in detail, so we can sort of skip past them, but we go out to the individual franchise owners who know their areas really, really well. And if we take the East Midlands, so there's an area that's doing incredibly well. I actually live about 7 miles away from Newark, which is at the top of the list, and it's quite an interesting area. So you can get good investment there, you can get good rental yields there, but they're finding that people are suffering. So economically, it's having a bit of a rough time at the moment. And they're forecasting for next year that rents will decline for both flats and indeed houses. And that's very rare, because if you look on the right-hand side here, what we are finding is quite a substantial difference, just as we are with prices, is that flats are not performing as well as houses. And actually, that's not a new trend. That's something that we've been tracking since around 2013 from the Belvoir index, and indeed on the house price side, it goes back even further to the last recession. But one of the things I like to do, and quite proud of with the Belvoir index that we've got, is that this is not a regional index. This tells you exactly how it is, and you get a little report from each of the franchise owners. So it breaks it down. And you can see there that if you reported that the Southeast was going up and you were in Watford, then actually you've got the wrong end of the stick, because they're looking at prices, rents decreasing. So it's really, really important to go and talk to local people that really, really know their market. I'm finding more and more that regional information, albeit that I present it, is useful to know, but the devil is in the detail. It's all about that property and the demand for that property and the supply of that property on that individual road. And I think this shows that quite well. So you'll see, if we just slip to their next slide, just in case you've got anything on there, I'll give you a few seconds to have a little look to see how that one's going. And Stoke-on-Trent's quite a popular area. They're actually doing really well, and I'm surprised at that, because Stoke-on-Trent to some extent is not that different to Newark, and they're having completely the opposite situation there. So very different. Doncaster, I know, is another really popular area, and quite good local authority there as well. So that's one looking at. And indeed, we cover areas of Scotland and Swansea at the bottom. So very, very, very varied forecasts for next year. Make sure you check with local experts as to what's going on. And really, my final sort of slide and message is, we've been tracking, and I've been banging on about, it's all about an individual property on an individual street, and that's how sensitive prices are, and that's how sensitive rents are. And they can be going up on one street, and they can be going down on one street, they can be going up and down on the same street. And that's the big message, really, for all of this lovely data that we have. It's all great and interesting, but the most important data for you is on pricing, is check sold property, latest sold property price data, and talk to really good local agents. And from a rental side, check to see the demand, see what prices, see what rents people are going for, and again, check to see what's happening with a local agent. That is the only way you will really get a good idea of what's actually happening out there. Don't be led by the kind of the mainstream forecasts, because I can pretty much guarantee that average will be an average of somebody increasing and something decreasing, and therefore you need to know, you need to be better than that, you need to have better information. So I hope that was a useful run through, and I think handing over to Chris, I think, Martijn.
Thank you very much, Kate. Yes, I think the economist expression is if someone's with his head in his oven and the feet in the freezer, they're on average comfortable. So it's.
I'm not going to try that though, if I'm honest.
No.
You're not up for that either, Chris.
Not really. No, not right now.
But it makes sense to buy-to-let is a investment, and treat it as a business and do your research, and you can outperform. You need to convince a tenant to come there. So know as much as you can. Makes sense. Even particularly as this sort of macro environment is big. But as Kate showed, I think it is tumultuous, but not as tumultuous as we all thought in April when the world was ending. So it is not that. It is wild water, but not an abyss. So can I hand over to Chris from the National Residential Landlords Association? Thanks again for joining us, Chris. And taking a slightly more broader view of the world, we thought it would be very useful to hear more about the burgeoning field of green homes and their grants. So we asked Chris to say something about that.
Absolutely. Thank you, Martijn, and good evening to everyone, and thank you for inviting me along to speak. I was actually quite glad you recommended that we talk about green home grants, because if there's one thing I've learned over the years, it's that if you're going to follow Kate in a speaking engagement, you want to have your topic as far away from whatever she's been talking about as possible, because there's a good chance there'll be very little left to talk about at the end of it. So we had to pick something that was very different. And
very
green home grants... It's always very comprehensive. But green homes grants are about as far away, I think, as you can get here. And I've been asked to talk about kind of what they are, why it's important that we learn about them now, how they work, and crucially by when we use them, because we talked earlier on about the deadline for investment with stamp duty. There's also a deadline involved with green homes grants. So, but if we kick off, if we can have the next slide with just what they are. Much like today, actually, Rishi Sunak, the Chancellor, stood up back in July to announce a pot of money for green homes renovations. And that's £2 billion that was allocated for this green homes grant scheme. The objective of which was to provide part funding to upgrade homes, including, crucially, homes in the private rented sector in England. The scheme itself, as I say, was announced back in July. It wasn't actually launched until the 30th of September. And there've been, it's probably fair to say, a few teething problems in getting people through the pipeline using it. But it's live now. It's there to allow homeowners, and as I say, unusually perhaps, including landlords, without any direct connection to their tenants and the need of their tenants in England, to apply for a voucher that they can use towards the cost of installing very specific energy efficient improvements, or again, specified low carbon heating improvements to homes. And the final point I've put on there is actually it's worth noting that on the day that this scheme finally went live, the government also launched a consultation on the standards that we'll have to adhere to in the private rented sector in terms of energy efficiency. So most of you will probably know there is a minimum energy efficiency standard for private rented accommodation. The consultation's live at the moment. It's very likely that will be improved or made more stringent in the very near future. So it's part of a wider package, and it's part of a wider direction of travel that the government are very much committed to. With the next slide. So I think one of the questions that I get asked quite a lot is that, you know, the need to address the energy efficiency of property is not new. Why are we looking at it now? Why is it important that we start talking about this now? And why has the government launched this particular scheme? I think at the moment it's quite easy to be quite cynical and to say that actually it's one of what will be a range of short-term stimuli to help us build our way out of the current economic crisis that we're in. I think my retort to that is, so what? If there's money available for improving and retrofit, then let's take it. I don't really care what the motivations are. I think if I were being a little bit more generous, we've got to recognise that there are quite a lot of targets that the government has got to, the government and us as a nation have got to hit in the not too distant future, not least the net zero emission target by 2050, which is one of the few legally binding targets we've got. And housing plays a role. You'll be glad to know this is the only squashed and slightly blurry chart that I've included in this slide pack, but I've included it there just as an illustration. You may or may not be able to make out the writing on there. This is an illustration up to 2018 of the of emissions in millions of tons of carbon dioxide equivalent. And the only one you really need to be aware of is the orange bar there. The orange bar is residential property. So you can see by no means are we the villain of the piece and the worst contributor. But you can see that we've not actually made huge strides in terms of residential property and reducing the impact. We make up about 14% of carbon emissions. And there's a big task involved if we're going to play our part as a sector in hitting these targets, because it's quite easy to focus on the decarbonisation of new homes. Setting standards for newly efficient property is, you know, if there's any builders in the room, they'll say, no, it's not easy, but it's much more straightforward than the retrofit task of existing stock that we've got to look at. And this, I think, is why the Conservative Party put in their manifesto last year, which seems like a decade ago, frankly, not just, what, 11 months from the election, that they would commit £9.2 billion to housing energy efficiency programmes. £2 billion of that forms what we're now talking about as the Green Homes Grants. With the next slide. So just to give you a quick overview of what this scheme is. As I mentioned before, it's this £2 billion scheme to help improve the quality of stock. It takes the form of vouchers that a homeowner, including a landlord, can apply for, which can cover up to 2/3 of the cost of these qualifying improvements. And that contribution is capped at £5,000. The type of improvement that you can invest in is split into primary and secondary improvements. I'll go into what they are in just a minute, but just to say that if you want to access something from column B in the secondary measures, you've got to have first taken up a primary measure. It works by means of these vouchers, as I say, that the homeowner can apply for, but an accredited tradesman is able to redeem. That's got to be done within 3 months of application or by the 31st of March 2022. Awkwardly, I was in the middle of writing this presentation pack when the government extended that. So that was going to be a very short deadline of the 31st of March next year. It's been extended out for another year. Mm-hmm. Interestingly, the time that you're able to take it up has been extended, but the amount of money available hasn't been. So that's going to be quite interesting to watch how that's spread. And the scheme is administered through the Gov UK website, which anyone who's ever visited it loves or loathes, and it's all encapsulated in there. Can we have the next slide? There we are. So as I said, all of the measures, well, I should start by saying, unlike some previous encouragement towards improving the energy efficiency of stock, this is targeted very specifically at certain approved measures. So if you do make an application to the scheme for a voucher, you have to have at least one primary measure, and they're broken down into these two categories. They are insulation and low carbon heat. I think the insulation side, we're all probably quite familiar with. Lots of the schemes over the last few years have focused on insulating properties. And you can apply for the voucher to cover solid wall insulation, cavity wall, roof insulation, loft insulation, and so on and so forth. It's worth noting, just for that second bullet point there, it will cover part of the cost of new installations, but the government have ruled out what they call top-ups, so improvement to existing insulation. So I think the best example is probably if you have loft insulation between rafters, you may have 100 mil of insulation. The recommendation is to take that up to 300 mil. You could make the application and be accepted for a voucher if you had none. If you've got that initial 100 mil, you couldn't get a voucher for the next 200 because the government have essentially concluded that the marginal gain for improving these things just isn't sufficient to warrant access to the scheme. The second category in the primary measures are probably things that most people are a little less familiar with. And they are very much the kind of first foray into getting people ready for the removal of gas boilers from residential property. So over the next few years, we will certainly hear more and more about replacements for gas boilers. I think the first restrictions are going to be on new build, but the private rented sector is very likely to be quite close behind. So the low carbon heat element of this will allow the vouchers to be used to part fund replacement of a gas boiler with an air source heat pump, a ground source heat pump, although the cost of those will be far in excess of the cap that's been put on these vouchers, or some potentially more affordable options like solar thermal heating, or some kind of hybrid systems. Those are the primary measures. If you've got one of those and you still have some headroom in the vouchers up to the 5k cap, you can look at the secondary measures. The secondary measures, it's important to know, can't exceed the value of the primary measures that you've taken out. So there is quite a limit there, and there's probably relatively few properties that are going to have that are going to be able to take advantage of the primary and secondary and not breach that. But the secondary measures are again broken down into two categories. It's windows and doors. So it's essentially installing double or triple glazing where you previously had single glazing. Just like with the insulation, the government aren't allowing top-ups or improvements. So it won't allow you to apply for a voucher to go from secondary glazing to triple, for instance. Again, the marginal gain is seen to be not enough. Or the last point on there is actually one of the few times that this particular scheme is talking about behaviour in a property and not just the fabric of the property. So the last kind of measure that you might be able to apply for here, or you can apply for and you might be eligible for here, are heating controls, and actually a bit more insulation and lagging on here, but predominantly moving from traditional dumb heating controls to smart heating controls and zoned controls, which might allow you to make more efficient use of the heating that you've got in the property. Can we have the next slide? So that's what you can apply for. The how it works should be straightforward, and I think the system has been made quite straightforward, although there have been question marks about the availability of the kind of tradespeople you need. You can make your application for one of these vouchers at the website that I showed on the previous slide. Presumably these slides will be available for people after. What the steps that you follow there's quite a useful checker. You can check your eligibility for any particular property and then go on to make your application. But before you get to the application stage, you're going to need to have done a little bit of homework. You need a few details. I mean, the first of the points on there, well, are your details or the details of the homeowner. Pretty straightforward. You will have had to get a quote for the works. And crucially, the quote will have to come from a tradesperson who is Trustmark registered. That's where I think the difficulty has arisen so far with the scheme. There do seem to be a shortage in some parts of the country of appropriately accredited tradespeople. The government have tried to assist with this by putting essentially a search engine on their website to allow you to find Trustmark accredited tradespeople. And local authorities, I'm told, are being encouraged to keep a database locally of the appropriate people. But you'll need to put in their Trustmark license in order to be considered for a voucher. When you go on to make that application, you can apply for vouchers for multiple measures, and you can use multiple tradespeople. But you do need to take account of the cap, and you can't pool your vouchers. Each voucher is allocated to a property and a measure. So you couldn't apply across your portfolio and then decide to consolidate them to do one big job on one property. Just answering that question that's coming up there, you only need the one quote from a tradesperson to access the system, although they do recommend, as you would expect, you have multiple quotes to make sure that you're getting good value for money. And the application can be rejected if the quote seems to be unrealistic. Worth noting that once you've made your application, it doesn't guarantee that you'll be accepted. So please don't start any work prior to getting the voucher through. They won't be redeemable if you haven't already got that acceptance beforehand. Moving on to how you redeem the voucher, this is all pretty straightforward. Once you've had the work carried out, you need to be satisfied the work has been carried out to an acceptable standard. You have to have paid your share of the cost, because remember, the vouchers can only cover up to 2/3 of the cost of the measures. And you need to have received any necessary documents, so guarantees on particular kind of installation systems, so on and so forth. After that, the landlord or the homeowner will be able to submit a dated invoice onto the same system when they made the application, and the outstanding sum is paid directly to the tradesperson. So it doesn't come to the homeowner, you or I, it goes directly to the accredited tradesperson, and it can cover the costs of the labour, the materials, and the VAT of those works. Can we move on? It's worth just bearing in mind that the Green Homes Grant aren't the only game in town when it comes to this. Any of you who are as dull as me and take a lot of notice of the small print in your utilities bill may have seen that we all contribute towards something called ECO, the Energy Company Obligation. I think we're actually on to ECO free now. It's been going for some years. There is still funding available. It's dependent on the circumstances of the person living in the property, so it's not quite as broad as the Green Homes Grant, but that is available. You can claim ECO funding and a Green Homes Grant on the same property. So there are more than one pot that you can dip into to get work done, but you can't claim them for the same measure. So you could, for instance, have eco funding for cavity wall insulation and a Green Homes Grant for loft insulation, for instance, and maximise the amount of benefit you can get there. And the other caveat to put on there, the £2 billion that was made available for this particular scheme, a significant part of that actually was allocated to local authorities for something called a local authority delivery scheme. Again, it has the measures that are available are similar to the Green Homes Grant, but there is a vulnerability component or an eligibility component in terms of the people who live in the property. But the thing you need to know when you're making your application to get a Green Homes Grant is if you, in respect of your property, the property you're applying for, have received LADS funding, you're ineligible for a Green Homes Grant. So do bear in mind it's one route or the other when it comes to that. I think we've only got one or two more slides. If we move to the next one. I've put this on here not actually because I think you need to know anything about MEES particularly, but because probably the number one question we get asked at the NRLA is, why should I care? It's very, very difficult to get landlords engaged and excited about this kind of thing, especially when some of these measures are very expensive. MEES, as most of you probably already know, is the minimum energy efficiency standard for property. It's the set of regulations that prevents you from letting a property that hasn't achieved an E or better on the energy performance certificate. Now, interestingly, a Green Homes Grant you won't qualify for a Green Homes Grant in respect of a property that doesn't hit that already. If it's let, it's deemed to be not compliant and therefore you shouldn't access the funding. But the rules are going to be tightened, and it harks back to that consultation that I mentioned earlier on. If we can move to the next slide. Currently, you've got to get to an E. None of this is finalised yet, but the direction of travel is very much in the direction of becoming more stringent. It's very, very likely that that's going to be moved to a C in the very near future, possibly, almost probably from 2025 for new tenancies and 2028 for existing tenancies. So I think the reason that I would very much encourage landlords who are in a position to carry out these kind of works to engage with the Green Homes Grant is you need to get ahead of the curve. You know, at the moment, we know that it's going to be costly. There is some money available. If that can get you to a C, or that can get you to whatever the maximum investment threshold attached to these regulations is going to be in the future, then I'd encourage you to do it now rather than wait till the last minute when it may be much more difficult to comply. I think on my final slide, I've just included some details of that consultation. If you're interested to learn more about what the regulations may be in the future, or better yet, to have your say to point out how easy or difficult it might be for you to get those properties up to the required standard, the details are all on there. But otherwise, I think that's me, and I'll hand back.
Fantastic. Thank you, Chris. I was not aware of that direction of travel to a higher EPC. I know that in my old country, the Netherlands, it is very hard to get any high LTV mortgage for a worse than C equivalent mortgage. It's delivered via different means, but definitely the hitting the sort of Paris Accord type emission standards requires movements on agriculture, but also on properties.
Absolutely.
So It makes sense immediately when you said it, but I wasn't aware it was so exact and precise.
Mm.
So thanks for that. I thought those were two very interesting presentations. We have a few Q&As, so I will ask the esteemed speakers to go through that. I can do the first one. I think someone asked about, are there any mortgages for LLP structures? There are, but there are very few lenders that allow them, particularly if there's more than two partners in it. Come to us for some free advice at Habito. But the more complex the structure, the more restricted access there is. It's not the broadest of markets, to be fair. The second technical mortgage question was around limited company rates tend to be a lot higher than personal buy-to-let. Why is that? We don't know. So at Habito, it's the same rate. But I think it was traditionally because we can. There used to be a higher underwriting charge, but I think I hope and we're leading the way in making sure that it's aligned going forward. So let's ask a very complicated one. Is there any advice on dealing with the external wall safety 1 form issue? So this is the cladding issue. Kate or Chris, I'm sure you're both spending quite a bit of time thinking about this issue. What do you think of the announcement yesterday, for instance?
So this is the biggest can of worms and perhaps the most costly disaster in the property field that I have ever come across. So it is really complicated. There are huge issues, and it partly comes back to the way the industry works, and it doesn't work well enough for consumers. And it's no disrespect to anybody, but what tends to happen when there is an issue like cladding, and obviously the awful Grenfell disaster, which has led to them trying to make properties safe. So they're trying to do this for the right reasons. You've then got that there isn't really massive agreement between lenders, surveyors, legal companies, etc., on how to deal with this. And partly from, I think, and Martijn, you might feel free to correct me, but a lot of the problems for something like this, and we had it with Japanese knotweed, we've had it with flooding, we've had it with the leasehold scandal that came through, is that all of the major services in home moving, for example, or buying and selling, all have to have professional indemnity. And these kind of things scare professional indemnity companies. So they make life, I think, a little bit harder. And we are looking at this. So the issue that we have is that the EWS1 forms initially were there to help people. And what is happening now is that they are becoming a reason not to lend, I think, for some, not everybody. The second problem that we have is that for you to get that EWS1, you have to have one of the, somebody come out, check out exactly what the cladding is made for, which is crazy because the developers should be giving that information free of charge, in my view, and I am asking for that to people. And there are physically not enough surveyors, as Steve rightly said, to go around and check the thousands of properties that have got cladding. So this is a big issue. Certainly if you're looking to buy, you need to try and make sure that you buy something that isn't trapped in this and you don't get accidentally caught, particularly if you're buying with cash. But as far as the 18-meter side, I'm going to be very honest with you. I'm catching up on the latest news on this on Tuesday. The recent news that has come out has basically said that if a building doesn't have cladding, you don't need one of these forms. Well, why on earth was anybody asking for one in the first place? Would be my question. It seems to have gone a little bit crazy. So we are in the midst of trying to sort this out, but it's a very large can of worms. So if you don't own one already, I would probably avoid at this stage, and if you do own one and you need some help, get in touch, because I will try and find out the best information I can for you. But Martijn, I don't know if you and Chris, if you want to say anything else on these.
Chris?
No, I think Kate's absolutely right. I mean, the thing that's really surprised us at the NRLA, certainly over the last couple of months, have been the variety of different members that have got in touch with us with properties that there should be no question about being caught in this. You know, we're talking about low rise, we're talking about traditional construction methods, yet they are still getting caught being asked for these forms. So, I mean, I must admit, I'm not quite up to speed with everything that's gone on the last few days, but it sounds like the direction of travel is positive, but still no particular solutions.
No, and I'm talking to people who are basically having kids and they've got one bed flats and they can't sell it. The point I'm making is that it's going to take you 15 to 20 years to sort this problem out, and they can't have grown-up children living up in a one-bedroom flat. So something's going to have to break, something's going to have to be sorted. And I'm really, really sorry if you're getting caught up in this. If I can help, I will. It's going to be a little while, and it's not going to be months, it's going to be longer than that, I think, for us to settle this, unless we can get the government to do some sort of fund or something, which is the only way I can see through this, whereby people apply for a hardship fund or something so that they can move on. That might not help investors though.
Yeah, I think yes, I wish I had better news, but I think it has not been solved yesterday. Where the announcement was, if you don't need a certificate, you don't need to get one. I think that's a bit circular. In essence, I think it's good that we make sure that people live in safe homes. But there is let me just ask for this form just in case deluge, pointing at, I think, 50 valuers that have the required training. So that is not going to work. I think the connection to flood is quite a good one, Kate. That maybe sort of industry-wide solution. So I fear there's going to be at least a few months of limbo while we try to figure this out.
Yeah, but we are trying very hard to see what we can do. So I apologise though if it's not fair you're caught in this, and I do apologise. We've got to do better, and the government's got to do better on this.
Cool. Conscious of time. Propose we finish on one question. Let me a question from Chloe. I think for you, Chris, how will properties that are exempt from EPC ratings, like listed buildings, how are they affected? Because even if you want to, it's hard to make changes. Do they qualify for improvements?
Well, at the moment, they're offered an exemption. So assuming we're talking about listed buildings or properties that are in conservation areas and where it would be difficult or impossible to get permission, there are, I think, 6 or 7 specified exemptions from the MEES regulations, and that's certainly one of them. There's no guarantee of what that will look like in the future, because the consultation is for what the new regulation will look like. But I think it's almost inconceivable that there won't be a similar list of exemptions. I would recommend that if people are concerned about their particular properties, do go along to Gov UK, look at that consultation and feed in, because you'd be amazed at the things that don't occur to civil servants when they're writing these. You know, the types of properties they're simply not aware of and the challenges some landlords might be facing. So do go along there and give them your story.
Yeah, I think community is made by all of us, so let's contribute. That's great. I must say, on a personal level, isn't it nice in the middle of this big health and economic crisis that green is not just salient with the government, but actually consumer studies are also showing not a drop off. Where it dropped enormously in weeks in the 2007-2008 crisis. People stopped caring almost overnight. I think everyone is really starting to solve the puzzle together. It's going to be hard, but I'm quite heartened by that.
It's all that fresh air we enjoyed in April.
Yes,
touch with nature.
Cool. Consciously, we're overrunning a bit, so we're going to have to leave it there. Thank you for Kate and Chris for your wonderful contributions. And thank you particularly to the attendees choosing to spend time with us tonight. We're going to, as I said, we're going to share the recording and materials on YouTube and our newsletter and via our website for further reference. And do get in touch if you have queries about something we didn't get to talk about today, or something you'd like us to talk about next time. We'd like these things to be as useful as possible to you. Thanks everyone, and have a really good evening.
Okay. See you everybody.